but want to get to our big guest of the morning. One of, I should say, very many big guests of the morning, Mike Wilson, Chief U.S. Equity Strategist at Morgan Stanley. Good morning to you, Mike. Thanks for joining us. You've been talking about this being a recession and maybe being a worse recession than had been anticipated. We're going to get these unemployment claim numbers a little bit later today. How are you seeing things right now?
Yes, thanks, Andrew, and hope you all are well. Look, I don't think that's a novel thought at this point. I think it's consensus that we're in a recession. It's going to be steeper than what we've seen probably ever before and sharper. The question is it going to be short or is it going to be elongated? And we're leaning more to the kind of short and sharp because of the policy response that we're getting is so dramatic. And, I think that's also pretty consensus now as well, given the bill has been passed, given what we've seen the Fed do. And I think the more important sort of question for investors is to think about, well, how has the market really been trading this for a while? And I think there's still some debate around, how the market has been expecting a recession, at some point, right? We've been trading very defensively leading up into this virus, shock, which is what tipped us over into the recession. And so the call that we're trying to make now is just to remind people that we've been sort of in a bear market for a couple of years for the average stock, not all stocks, and many stocks never made a new high at the end of last year. And we think there's been a giant consolidation, and just to remind folks that bear markets tend to end with a recession. So we think the bear market's ending. We think we've been scaling back into stocks over the last 2 or 3, 4 weeks, and we know we're not going to catch the bottom exactly. And we think this is probably the best risk reward we've seen for investors in 2 years.
So Mike, a lot of people, of course, are asking the question, have we hit the bottom? Where is the bottom? We've had these two up days now. Folks are looking at the curve, the numbers. Perhaps the numbers in New York may be better. I think there's a real question about that right now. But how do you see it? Do you think a bottom is in?
Well, I think that's not really the right way to think. That is the right way to think about it, but not in calling it to the day, right? So no one is good enough to call this stuff to the day and to the dollar, and that's not really the point. If you have real assets to put to work, which most of our clients do, you need to be thinking about, is this a good price? Like, do I like this price if I'm investing for the next 6 or 12 months? And we do. We like these prices. We like these prices a lot, particularly in some of the credit markets, particularly in some of the higher quality equity markets, and even some of the lower quality equity markets.
So, Mike, make the case for the V, though. Make the case for the V. So you see what happening over the next 2 or 3 months?
Yeah. So it's going to start with today. We're going to get a shockingly high claims number that has been pretty well telegraphed at this point. Unemployment rate is going to shoot up in a way that we've never seen before. And so let me explain kind of how the unemployment cycle typically works, which is usually when a recession begins, it starts with claims popping up and you get layoffs slowly. And it takes typically 2 years for the unemployment rate to peak. All right, this time around, there's a good chance that the unemployment rate peaks in a month or two, meaning it's the most truncated, shortest unemployment cycle we've ever seen. That's not a guarantee, right? And that's not necessarily something we can predict with accuracy. But the magnitude of the move suggests that is a real possibility. And so that would argue for, then on the other side, that the unemployment is not going to shoot all the way back to the low. But remember, the market bottoms when the unemployment rate, people feel like all the bad news is price. Markets bottom on bad news. And that's the case for the V, is that it's just been so sharp and so truncated. And then you're going to have this unbelievable policy response on the other side that the market's going to look straight through this valley because it already went down 35% on average.
Hey,
Mike,
Joe?
Yeah, thanks, Andrew. Mike, that's all very, very interesting in a lot of respects because no one really predicted this. We're going to talk to Paul Tudor Jones, who was obviously very, very worried about it in Davos. But in a certain way, and maybe it's a way to look at it with not a silver lining, but one of the positive things is what you're describing, and that is a long-in-the-tooth bull and a long-in-the-tooth expansion that one way or another, some of the excesses were going to get wrung out of it. And this provided that in a hideous way, obviously. But for someone purely that does what you do for a living, it set up an entry point long-term that was better than what you've had in the past couple of years. Is that fair to say for you?
That's exactly our narrative. And, Joe, we've been talking about end of cycle for a while. We never know what the trigger is going to be, but the conditions for a recession were in place, right? Like, in other words, the credit markets are having a really tough time, not because of the virus, but because, the credit markets were extended. And we've had a lot of excess in the credit markets, particularly in the corporate credit markets, and also in the shadow banking system. And so you just needed a trigger. And I would argue strongly that it was not just the virus that was the trigger, but it was the oil price collapse, because that's what really started to infect the credit market. So here we are. And you're, as investors, you have to always be thinking about kind of, A, what's the market already priced, and B, what am I thinking about over the next 6 or 12 months? And once again, like, we don't know if it's going to be a V or U or whatever. We don't think it's going to be an L, okay, but it's going to be some sort of recovery in the back half of this year, and we'd like these prices, and that's how we do it. Just like we were saying last year that we thought the risk-reward was not that attractive, given that we felt we were closer to the end of a cycle than we were mid-cycle.
And 3,000 is a bullish case for you.
That's right.
Which would be a big return from where we are right now.
Mike, we had somebody yesterday describe this as a potential W recovery, just up and down and up and down. You think that could be? You said, it's not going to be an L, but if it's a W, does that concern you at all? Do you tell people to time it, or you just say, don't worry on the day-to-day moves?
Well, it depends on the client, obviously, right? Because we have all different types of clients here. We have short-term focused clients. We have asset owners who are thinking about the longer term. Look, if it's a W, fine. And by the way, that's a typical bottoming process. As long as I'm doing my buying towards the low end of what I think the right range is, and we've articulated that as sort of 2,400 to 2,500, and we overshot that, by the way, this week. Okay, fine. So it gives us even a better entry point. That's the way to manage, longer-term money, is to say, I don't know what the bottom shape is going to look like. I don't know how this is going to exactly play out. But if I like this price and I want to acquire assets here at a price I haven't had a chance to for the last couple of years, I'm going to start doing that. And that's what we've been doing.
Joe, jump back in.
I would. I think we were trying to get Mike Santoli, but I'm fascinated by Mike's analysis here because, Mike, in your view, I guess we overshot a little bit based on fundamentals when we were up on the S&P well above 3,000. And now, you're talking about that's the bullish case getting back there, but you're probably pretty comfortable with a market valued at 3,000 if it were to, in your bullish scenario, to get back there. And valuations at that point would be more reasonable than they were when we overshot it 3-4 months ago. So I'm just kind of amazed to see you so sanguine in the midst of all of what we're all dealing with, but it makes sense, and historically that's the way markets perform. So I don't know. I guess I'm saying I'm gratified and kind of think you may be onto something here.
Well, I mean, think about it this way, right? So markets do they're generally pretty efficient, but they do overshoot in the short term, both on the upside and the downside. And we are going through a terrible situation right now where people are scared about not just the market but their health, and that sets up a perfect situation to overshoot. But think about the fourth quarter of last year, and we were discussing this with you all on the show, and others were too. But everybody knew we were kind of getting a little bit euphoric. The Fed was active, and there was a lot of leverage coming into the system. We track a lot of these sort of leverage players, obviously, and we track a lot of these types of strategies that have to participate when markets go up or down. And we wrote about that back in the fall. They were extremely levered in the fourth quarter, and now they're completely delevering, right? And that's what's been driving this overshoot. And these are things like, risk parity strategies and vol targeting and trend following strategies and other passive strategies. And so, yeah, I think that this is how the market works. It ebbs and flows around these pain points, right? Pain can be on the upside as much as it is on the downside. And I think we've experienced two really good examples of that with the fourth quarter of last year and then now what we're experiencing with this recession.
All right, Mike Wilson, thank you.